welcome back to FreightWaves. Now I'm here with lead economist Anthony Smith to take a look at our shippers, to maybe some economic data. What do you have for us?
That's right, Andrew. So I have something right up your wheelhouse. We're looking at consumer spending or personal consumption expenditures. We have that here in the blue line, and right up against the orange line, we have, of course, our outbound tender volume index for dry van trailers. And so looking at that, the latest number that we've seen with the consumer consumer spending or PCE, we saw that it was essentially flat from last month for the most recent May number. But it's going to be a little bit stronger than that we'll anticipate because the April number actually got an upward revision, up 0.9 from 0.5. So there is an upward revision there. So that flat isn't as weak as many people were thinking it was because of that upward revision from the month before. Also, there is or has been some drying up of stimulus money. So I think that flat month-to-month movement is somewhat impressive with that lack of additional fundings coming in.
I know we certainly care about goods demand here in the freight industry, but does this retail sales number a little bit understate the consumer strength, at least because we're not getting a lot of the service-based spending that they are reverting back to right here? I mean, do you see that flattish number and think, oh, this is a bad sign? What do you think taking away?
Definitely. So, I mean, when we're looking at this number specifically, this is going to be for durable goods, which is going to be much more related to freight and transportation. But the services is also impactful for freight and transportation because that's going to mean more services, typically means less on durable goods and things like that. So definitely I think there's going to be that switch. I think one of the great pieces that you wrote at the beginning of the year talking about that switch from durable goods to services as more and more the economy opens back up is going to be definitely at play here, and that's what we're kind of seeing in real time right now. So I think that's definitely going to be here, applicable here. I don't think it's going to be too overt or anything that's going to be too crazy or catastrophic for volumes coming down. But it is something to watch, of course, and take note of.
Yeah, it's just what we were saying with Kevin is that not only has consumer demand, the reversion has happened. We are spending a lot more on services, but goods demand remains really strong. And then even if goods demand were to decline, inventories are so low that retailers are going to continue to be pushing out and bringing freight in. So it should keep freight markets humming.
That's right, and I think for shippers, the thing is that consumers are confident. They have a ton of savings right now. They're not even all that phased, it seems like, for the moment, from these inflationary pressures that they're incurring right now. So the other big thing is I don't think consumers are going to be all that rational as some of these economic models were to kind of lead to when we're thinking about this shift fully going on right now, because although they are sitting on a lot of savings right now, consumers typically have short memories. And one of the things that's happened since the pandemic, really since February 2020, we've seen a decline in revolving credit, and those credit rates right now are at 2016 levels, essentially. So 2016, 2017 levels. And so we're seeing that credit card utilization is down, revolving credit is down. So consumers are in a better place. They have more funds, and they have a little bit more flexibility with the credit card spending. So I anticipate that credit card spending to kind of edge back up as time goes on. So that means that we are going to see, I think, more spending on goods, more savings kind of being depleted somewhat, and more credit card utilization.
I guess I'm just asking for a little armchair economist here. You know, it seems that the elasticity of demand has widened a little bit with a little bit of this free money and a little bit of the fact that we didn't do any traveling last year. And you're right, it does seem that consumers are a little bit numb to the price inflation that we're seeing, especially at CPG and at restaurants and things of that nature. Do you think that lasts? Do you think we get towards the end of the year or into next year and you think American consumers think, well, you know what, I've had enough of these high prices. I'm not going to spend as much. Do you think that does happen, or do you think that this widened elasticity of demand can last for another year?
I think that widened elasticity can last a little bit longer, but towards the end of the year, that's going to definitely be somewhat of, I think, of a breaking point, and that's going to actually come down to Jerome Powell and the Fed looking at how the Fed mitigates some of these inflationary pressures. And so as of now, they are kind of taking a little bit more of a closer look at it and giving a little bit more attention than originally, because there was some anticipation of inflation coming up throughout the year. But I do think they're going to need to put a little bit more attention on it, just because that widening elasticity won't be the case, I think, as we get towards the end of the year and, of course, into 2022. But, of course, that's also going to come down to employment, and if more consumers are going to go back to the workplace and actually have these jobs that they feel like they're getting these livable wages that's going to match maybe some of the lifestyles that they were having throughout the pandemic, with a lot of that remote time, being able to work remotely, spend time with family, that childcare aspect of it all. So a lot of aspects kind of to go into play as we get towards the end of the year, but the consumer should have more than enough to kind of carry us to there.
There's almost a dichotomy between the ones that kept their jobs and the ones that did not keep their jobs. Many of those were in service-based or low-income areas. They are not doing very well. But the people that did keep their jobs, they are flush with cash from stimulus. They are flush from cash from not traveling last year. So there is a dichotomy here that is going to be really interesting to watch it play out over the next year.
Definitely, and as I said, shippers going to be in a great place because people are going to be able to buy those products, but going to be having a hard time trying to find more people to work in those factories.
Yeah, labor is certainly an issue.